Okay, students, this is video 7, I believe, for chapter 9, and hopefully we'll finish it on this one. We'll see. But I was working on this homework problem when the other one ended, so we will just kind of recap a little bit of the first part of it here. So Bluestone Company had 3 intangible assets at the end of the current year, and so it asked to compute the acquisition cost for each one. So a patent that was purchased for a cash cost of $9,300, so that's its acquisition cost. Trademark was registered with the federal government for $10,000. So that is its cost. It's only the cost of actually registering it. And then the computer licensing rights were purchased for $60,000. So that's its cost. So there are the cost numbers. Now we come to the second part, compute the amortization of each intangible for the current year ended December 31. So the patent was purchased at the beginning of the year for $9,300. When it's purchased, the patent had an estimated life of 15 years. So we're going to take 15 years divided into $9,300, and that will be $420, I think, if my math in my head is correct. $620. I'm sorry, I messed up there. So, but that's 9,300 divided by 15 years. Okay, second one is a trademark, and trademarks have an unlimited useful life, and so there's no amortization on it. And the computer licensing rights were bought again at the beginning of the year, so we don't have to worry about a partial year. $60,000, 5-year life. So $60,000 divided by 5 would give you $12,000 per year. So we get $12,000 there for that one. No amortization on the trademark. Okay, number 3, show how these assets and any related expenditures should be reported on the balance sheet and the income statement for the current year. Well, the amortization expense will show up on the income statement. The assets should be reported net of the accumulated amortization. So here we see the income statement and the amortization expense. And then on the balance sheet, show the 3 assets and then less accumulated amortization. Okay. Now that gets us through that. Let's move on in over here and get into turnover analysis. And fixed asset turnover ratio is measuring the turnover of fixed assets. Not really the turnover. It's not a good name. What you're doing is measuring how efficiently did you do at using fixed assets to generate revenue. So to do that, we take our average net fixed assets, so net of accumulated depreciation, average meaning average beginning and ending net fixed assets, and we divide it into net revenue. And so that tells us how good of a job did we do at turning fixed assets into revenue. Now that is going to be, as with most ratios, very dependent upon industry. So industries that are low on fixed assets, like perhaps software development, they don't really have to acquire, storefronts and, hotel buildings or something like that. They have some computers, some programmers in kind of an office building, and they're churning out software or video games or something like that. You would expect theirs to be a lot higher than maybe a hotel that spends millions, if not billions of dollars building a big hotel and then renting out rooms in it for the next 20 or 30 years. So very dependent on industry. And even within industry, you see different companies that take different approaches. Some hotel chains actually rent their buildings. They find somebody else who will build the building and rent it to them. And that company is making money by the fixed asset, and so they have very low fixed assets, where other companies build and own their hotel buildings. So you have to look at it very carefully, but that's how you calculate it. So we have a homework problem on that. And right there. So compute and interpret the fixed asset turnover ratio from a financial analyst perspective. Following data were included in a recent Apple Inc. annual report. So compute Apple's fixed asset turnover ratio for 2014, 15, and 16. So to get average net fixed assets, we're going to average beginning of the year and end of the year. So ending 2013 is beginning 2014. So for 2014, we're going to average these two numbers, divide it into net revenue. 2015, average these two numbers, divide it into their 2015 revenue. And the same for 2016, average these two numbers, divide it into net revenue for that year. So let's just come on over here and we'll let the authors do the math for us. So there's net sales. You can see average net fixed assets would be around $18,612. Actually, it'd be exactly that. Divide that into $182,795. We get a fixed asset turnover ratio of 9.8. In other words, for every dollar of fixed assets during the year, they generated $9.80 in revenue. For 2015, it was 10.8. For 2016, it was 8.7. And you can see how that jumps around. Revenue increased steadily, but so did fixed assets. And it's low here because apparently they made some major investment in fixed assets during that year. So then the next part of the question, during 2016, Microsoft reported a fixed assets turnover ratio of 5.2. Was Apple's turnover better or worse than Microsoft's? Well, Microsoft was 5.2 in 2016. In 2016, Apple was 8.7. So Apple's was better. Bigger is better here. Bigger means for every dollar of fixed assets, they generated more dollars in revenue. So was greater than Microsoft, suggesting Apple's more efficient than Microsoft at using its investments. Fixed assets generate revenue. And that gets us to the last homework problem there. And let's see, that ends that. And that's really pretty much it for the chapter. They talk a little bit about different depreciation methods and their impact on the financial statements. I talked about that a little bit as we went along, but nothing really dramatic there. They talk about EBITDA. That's something finance people talk about. And it's earnings before interest, taxes, depreciation, and amortization. And it's something finance people like to look at. You'll learn about it in your finance class. I'm really not going to cover it. Natural resources. Natural resources are depleted rather than amortized or depreciated because you literally remove them. So as you produce oil and gas, you remove the oil and gas from the reservoir, you deplete it. Now, depletion is almost always done on a units of production basis. So I do teach a petroleum accounting class for upper level accounting majors. So if you're an accounting major, you might give some serious thought to taking that class. That is a major industry in this area. They do employ quite a few accountants, and it's an industry that tends to pay well. So here you see the units of production method is often used to compute depletion, pretty much always is. And then changes in depreciation. Changes in depreciation are always viewed, even if a change in depreciation method, it's always viewed as a change in estimate, because the depreciation method itself is actually an estimate. Theoretically, we should choose the method that best matches the way benefits are used up. And so because everything's an estimate, it's always accounted for as a change in estimate, which means in the current year and in future years. There's never any revision of previous year's financial statements. And that gets us to the end of the chapter. Pay attention to the demonstration case and the review at the end of the chapter. Really give you a good chance to review everything, make sure you understand it. And with that, we will complete chapter 9, and I'll get these up and they'll be available for you. And study hard, work hard. Hope you had a great break, and I will see or talk to you on the next set of videos for chapter 10.